All right. So, okay, let's kick things off here. Today, we'd like to introduce you to the Accounting Pros Guide to Funding Advisory as a Service. Kind of a exciting new term that we're trying to popularize amongst the accounting community. And so I guess before we jump in, I know you're all very happy accounting professionals, but I want you to first imagine that you want to launch a Colombian cafe. So you just got back from vacation and it's sort of top of mind. So you pour everything into planning this business. You've identified the location, you've got a business plan, some savings to get you started, but it's not enough. You need a financial boost, really, to be in a position to open your doors. So naturally, you go to your bank, your trusted financial partner, but they deny you. At this point, does your dream to open this cafe die? Sadly, this can often spell the end for many ideas before they've really even had a chance to start. So, your investment in today's workshop will really impact your ability to make these dreams and other funding related opportunities possible without requiring you to become a funding expert. So my name is Curtis. I lead our partnerships channel with accounting firms, and I'm joined today by our resident funding expert and team lead, Byron, to lead the conversation today. In terms of our agenda, we'll spend a few minutes talking about the funding landscape and introduce you to Swoop. We'll also jump into some popular funding use cases that come across accountants' desks. And I'll finish by providing some practical strategies that you can use to introduce funding advisory as a service into your firm today. And we'll save 15 minutes towards the very end for Q&A. And I'd suggest that if you have any questions throughout the presentation today, feel free to drop them either in the chat or in the Q&A section. Byron and I will be monitoring the chat. And as you go through this, you may also be thinking about some funding scenarios that have come up recently with your clients. So feel free to write out or give us an early indication of what that scenario looks like, and we'll have Byron chime in with how some strategies and how to approach it. Okay, so as we touched on in our opening example, funding is a major pain point in the market. In fact, about 80% of businesses have expressed concern about their ability to access capital, especially during turbulent market conditions when you look at things that are happening in the macroeconomic environment around tariffs, things of that nature. So it's no surprise that navigating these questions kind of come up from time to time with your clients. So many businesses don't realize that they have options beyond their bank. They're not really sure where to apply or access those options. And if they do get an offer, it's hard to know whether or not that offer is the right one for them just because they got a term sheet. And so they really rely on their advisor to provide context for what's going to make the most sense for them long term. Now, the current process for many firms today, and including for myself, I previously ran a small bookkeeping and payroll firm. The current process with many firms is to send our clients to a few people to contact. So my previous firm, we had commercial loan broker that we would sometimes refer to. We'd have a contact at the BDC or another bank that had referred business to us in the past. And so that's about it as far as our involvement. And it became very easy to lose track of that opportunity. And so that's really where Swoop kind of swoops in. We've built an international marketplace for accounting partners to access funding products across the range of funding products. So loans, grants, equity matches, as well as a savings marketplace. And the beauty of this is that it's all accessible with a single application journey. So really no need to run bank to bank or Google endlessly. So single platform plus friendly support from our funding team to bring financial solutions to you and your clients. And so for accounting firms, this doesn't mean that you need to become a funding expert. You can really lean on your partnership with Swoop to do the legwork. And at a really high level, how we provide value to our accounting firm partners, well, we provide you with a free partner portal to access over 200 lenders in North America, 700 plus if you include Ireland, UK, South Africa, and Australia. You'd have a dedicated funding manager to save you and your clients time and coordinating between lenders, uh, and as well as dealing with any funding related questions. And then assistance with navigating your funding options. So ideally, we've got a number of term sheets. It could provide guidance on what could be the best long-term option for the business. And our business model is built upon success, meaning that your clients don't have to pay anything with us, typically, unless we have success with getting them funding. Most of our clients most SMBs will pay nothing with us, as certain lenders will pay us a referral fee. So why get involved with funding? Why even consider introducing funding as a service into your practice? Well, as illustrated in our opening example, the opportunity for impact is massive. According to Goldman Sachs, approximately 80% of businesses are concerned about their access to capital. And your clients are increasingly turning to you over their commercial banking relationship partner. In fact, they even know who that is. According to Sage, over 80% of accountants have been asked to help with financing options in some capacity. And so you really, as their trusted advisor, are really in the best position to remove these financial roadblocks and offer solutions. So what solutions are out there and what does that mean for you? Well, today's session isn't about turning you into a funding expert. It's really about creating awareness of what the options are and knowing where to direct them so that they have the highest chances for success. So take, for example, an e-commerce business called Acme that's just in the startup phase. Acme may open up a credit card to keep their business and personal spending separate. And they'll use that to fund things like inventory and marketing expenses. But as you know, credit card debt can be quite expensive. And then so as they ramp up, they start to learn about startup financing programs like the CBSFL, Futurepreneur, as well as some other unsecured revenue-based options that may offer them quick injections of cash to get some better rates. So there are a number of options at the startup phase. So it's not only upon the business owner to fund the entire operation. Now, as they scale up, they acquire assets, they start to develop their credit profile as a business, and they start to look for something with some better terms, like a line of credit or some asset-based options to really increase their cash flow and build up a bit of a buffer. And so as they find their product market fit, they also start to learn about grant programs and consider taking on investors to really accelerate the route to market. And lastly, as Acme fully matures in terms of their business model, they've got an established position in the market. It may look for alternative pathways to fuel their growth and defend their competitive moat. So you can think of opportunities such as acquiring a supplier to access better margins and benefit from more vertical integration. They may also seek to acquire commercial real estate for their warehousing facility and production center. So realizing, and also there's an opportunity if they realize that their purchasing power is increasing. Well, there's also the opportunity to look for more favorable rates on things like foreign exchange, and other financial products to increase their margins. So just to summarize, I wanted to impress upon you that the stage of a business's maturity will create more opportunities to create leverage, build in contingency reserves for your client's cash flow, as well as for them to accelerate and achieve their targets for growth. So now here's where we get into the real world funding scenarios with our funding expert. We're going to introduce 4 common funding use cases that you, as the trusted advisor, will undoubtedly come across. And if you can't, again, if you've come here with funding scenarios of your own, would encourage you to drop those in the chat for discussion. So for this workshop, I'd like to introduce you to this key visual, which is one that I'll share with you following our workshop today. It's really a handy printout that showcases what the funding options are, depending on the client's stage of business growth, as well as some questions that you can ask that will identify whether or not they're in a position where they could benefit from accessing some funding. Okay, so now I'm going to jump into funding scenario number 1. I'd like you to imagine that you have a client that already has a successful health products brand. And then, as is common with entrepreneurs, your client spots an opportunity to diversify their portfolio and wants to open up a new sales channel by opening a fitness franchise location. So they've come to you with this plan. They've identified that they need $300K to fund equipment purchases, renovations, marketing, as well as working capital, as well as a suitable buffer to pay for your bill. So your client comes to you with this plan and asks if you can help. Now, if your client is unsuccessful in securing the funding they need, unfortunately, they'll miss out on the opportunity potentially to a competitor. They may attempt to bootstrap the business, which could lead to a failed launch. So also could result in some level of financial disorganization if they're not investing appropriately in their business. And unfortunately, that will kind of potentially land on your desk with a failed business and, I guess looking to you to make sense of what happened. So I'm going to turn it over to Byron to shed some light on some potential solutions here.
Hey everybody, hope everyone's doing well. Yeah, so as Chris said, I'm sure this is a common scenario that a lot of you come across. What I can imagine being is you've got a long-standing client, or you've got referred by one of your long-standing clients. You've got somebody coming up to you and saying, "Hey, you know what? I want to open up a business. I need some support." So a lot of times, what you're tasked to do or what you're requested to help out with is, creating a business plan, creating financial projections. But then you're kind of left with where do these customers go? Where can they get funding from? That's kind of where we step in, and that's what I want to do is I want to highlight a few different options that are available for these startup loans if you do have these opportunities to come across for some of your clients. So the first one is, and a very common scenario that we use, is the Canadian Small Business Financing Loan. So this is a great program for people looking to open up restaurants, gym studios. It's also a program not necessarily just for startups, but for small businesses in general. The program itself is actually set up so that it makes it pretty easy for new businesses to get capital because they're willing, because the government guarantees it. It allows the banks to take on the risk of lending to a new company, especially one that's a startup. So there's going to be no historical performance. All we're working off of is financial projections and a business plan. And this program, given that it's guaranteed, it allows us to utilize this program and help these business owners access capital. So there's a few different nuances with it. I just want to go through it really quickly with you. So there is a program that goes up to 500,000. I mean, there's up to $1 million if you're going to look at it if you're going to be looking at it with real estate, but up to 500K in most cases. 350,000 of that can be used towards equipment and towards leasehold improvements or renovations. I find renovations to be one of the most tough things to finance, and this program allows a lot of businesses to access that. Then there's a top up of up to another 150,000 to get you that total 500K, and that can be used with for working capital. It can be used as a line of credit. It's really just to kind of help with operational expenses. With this program, 75% of it is actually guaranteed by the government. So there's actually only a personal guarantee requirement of 25%. So if you have these customers or these business owners that are, hesitant, they say, I don't want to step in, I don't want to put my house up. It's good to know that this program exists because it does allow a lot of flexibility. It gives you longer terms. It gives you some good rates, especially for a risky project like a restaurant, for example, right? Knowing you're going to be at the forefront of these conversations, you're going to be kind of going down the route of, building the business plan out, helping with their project costing, helping their financial analysis. Knowing these project costs are there, and what's available, what we can do is we can help you almost like manage the application or manage the actual ask to make it successful in funding. So this is kind of a very good tool for us. There's quite a bit of information. I mean, there's quite a bit of information out there online, but this is definitely something that we can navigate, and it's administered through all the big banks. We've got relationships with all of them. We've got direct lines of communication, and essentially what we try to do is we try to streamline it, take that, I guess, that need off of your hands, so that we can go out. You can save your time and energy. And then what we do is we come back with a few different options. I've already vetted it with a few different banks and lenders, and then from there you're able to kind of present those options to your business owners and present those options to your clients. The next one is a BDC loan. I know a lot of you are very familiar with them. So they can do startup financing, and they typically will go up to about 250,000, depending on the industry, depending on the actual, I guess, client profile. It's something that is acceptable. Now, the Canadian Small Business Financing Program, as well as the BDC loans, they can stack together. Now, there is going to be a requirement where the owner is going to have to put in some money. There is typically a down payment requirement, but that is another element that we can help figure out through either consumer loans or personal lending or leveraging personal properties if we have access to that. But ultimately, when we're looking at it from a commercial standpoint, those two are going to be very, very strong suited options. So BDC term loans as well as the CSPFL. The BDC term loan, again, this goes beyond startups. They are mandated by the government to provide capital to different types of businesses within Canada. So it's not to say, we're defined by that, but in terms of startups, we're looking at whatever options are available. Now, the third option, and this could be another common use case for you, and this is called the Futurepreneur Program. It's actually for entrepreneurs that are less than 40. So what we find is that a lot of entrepreneurs and like that, 20s and 30s, they may not have the net worth, especially with housing prices where they're at now. They may not necessarily have the net worth that's available for them to leverage or maybe looked at differently. So with this program, they recognize that these entrepreneurs may not have it. They provide that support for these businesses, and they provide that support for these entrepreneurs so they can actually start up a business. Now, this one can go up to 75,000. So there's a combination between the Futurepreneur as well as the BDC. But it is, again, a great tool for some of your younger entrepreneurs and some of your younger clients. Now, these three are just some of the general options. There are some grant options. But outside of that, if you are looking for equipment, if you are looking for some smaller loans, like there are typically some solutions for us to work with. But with that being said, these options are more so covering, the working capital component of it, covering the actual renovations, the hard parts to finance, like the non-physical assets, versus if we are looking to finance physical assets, then we've got some leasing and some other types of equipment finance options. So when we kind of go down this route, again, our job is to kind of coach you through it and actually put together a project that's going to make sense, that's actually going to be able to get funded. So in this scenario of what we're looking to do here, the fitness franchise, knowing that a lot of it's going to go towards renovations, a lot of it's going to go towards equipment, we recognize that, okay, the CSPFL is actually probably going to be the best suited scenario here. So we'll approach them. They're still going to require some owner financing. That is going to be hard for us to avoid, unfortunately. They want to see some skin in the game. They want to see that, if they're going to take on the risk and they're going to provide some support, they're going to want to see that you're able to step in and you're able to actually, you're invested and you're sharing the risk with them. So with that being said, we would look at something like a CSPFL of 250,000. We'd be looking at them putting in about a 50K kind of owner financing or some kind of equity injection on their side. And then we'd be looking at, around an 8% rate, 8 to 9%, depending on where things are at. with a monthly payment of about 5K. So it becomes a lot more manageable for a startup, especially if someone doesn't have the cash available to do so. Even if they did the cash, using debt is always a very good tool for us to utilize in terms of actually helping them protect that. They can use that for growth later on. And especially when we're starting up, knowing these programs are there, it gives us a good starting point.
Great, thanks. So I think just to go back to our opening example, I think this case is probably a good one to highlight. Maybe Byron, do you mind
Yeah.
just speaking to this one a
Yeah.
little bit?
So this is actually a Colombian cafe out in Queen Street West downtown, just across Trinity Bellwoods. Excellent coffee, excellent snacks. So I do highly recommend if you're in the area to check them out. But they were initially came to us, they were getting declined by their banks, mainly just because they weren't presenting it in the correct way. So they were having conversations with their banks. They didn't have the right kind of net worth, or they didn't present their business plan that shows they're looking to buy equipment and real and leasehold improvements because they were actually acquiring it from a previous owner. So what we did is we actually went in there. We actually went through the business plan, adjusted it accordingly, made sure that they had the right wording, and we showed the project cost. And then from there, we actually connected them to an actual lender who was in the area, knew the location quite well, has a familiarity. We were able to kind of squeeze this through actually into credit, into approval. And this turnaround time was actually fairly quick. We had this turnaround in about 3 weeks, 3.5 weeks. So we were able to get these guys funded to access a good space with existing equipment already there.
Okay, so jumping into our next example, and I'm sure this has never happened to anyone on this call, but I've heard that some firms deal with cleanup work and happen to work with business owners that don't understand things like CRA filing obligations and payment obligations. So I know that's nobody here, but so I want you to imagine that you've come across an opportunity with a new client. Revenue looks good, about $1 million a year, but they're 2 years in arrears. They haven't paid HST, paid, corporate income tax. So they're behind. They're upside down with the CRA. So all in all, they're about 500K in the hole with the CRA, and they need to clear up this debt to get back on track. So we know that the implications of not addressing this is various serious implications. So sure there's interest and penalties, but there's impact to cash flow, along with the stress and concern about the potential personal consequences if they don't address this. So I'm going to turn it over to Byron again to introduce some possible solutions here.
Cool. Appreciate it, Curtis. Yeah, so this is actually an increasingly common scenario we come across from a lot of our accounting partners. So what happened during COVID is a lot of businesses, they had some challenges, they had some cash flow issues, took out some debt, and then they realized that they didn't have the cash flow to pay off some of their CRA obligations. Now they've kind of crawled out of that hole. They're in a situation now where they can start growing, but they're hindered by this CRA debt or this obligation from the taxes. Now, what you could do is they could try to pay it off. A lot of times they don't have the cash. They're trying to go get loans, maybe from the banks, and the banks are declining them. They say you need to clean up first in order for us to get to the next step. And it's actually hindering their growth. So these companies are growing, they've got orders, they want to be able to actually meet some of their customer, I guess, interest, but they aren't because they're limited by the actual availability of capital to them. And one of those challenges is because the banks aren't getting involved. So what we do and what we try to do is we try to separate out into a few different things. So there's what we look at in this space is we're looking at more B tier and alternative lenders. And what we'll try to do is we'll try to separate out, term loans, and then which is just general working capital. We'll try to see if we can utilize some of these assets and almost bridge them to a capital raise through a bank later on. So, we may be taking on some higher rates up front. This could be maybe a 12-month term, even less than that. And really what we're doing is we're leveraging their assets, cleaning up the CRA balances, getting them current. And then from there, once they've kind of put together a few months back to back, show that growth, able to file their financials, we're able to actually go to a bank again and get them a larger facility and repaying all these additional predators that they've taken on. But it is a very successful way that we've done this. And it's a very fruitful way that can help them get into that growth stage. It just may take a little more time while we're bridging them. So a few different avenues that we'll take in this case. So a term loan is fairly self-explanatory, where really what it is we're trying to get them an injection of cash, um, termed up, up to 25 years if we're looking at real estate, but really, we're looking at a 5 to 10 year term, sometimes maybe a little less, and it's going to be a quick monthly payment injection. Is going to show some profitability in their business that's able to service debt, and we're getting them capital in. The next thing is going to be an asset-based loan. So, every company has got some assets on their balance sheet. We're looking at receivables, we're looking at equipment, real estate. Is there equity in there? If we take out the debt or if we pay off the debt, how much equity is available? And do we have enough to actually service? So what we'll do is we'll look at appraisals, we'll look at equipment valuations, and we'll say, okay, so in the scenario we're talking about, you've got 500K in free equity that we can leverage. So we'll go to a lender, try to pay off their first, get them up to 75 to 80% loan to value, and now we've got 3 to 400K we can work with that can be used to pay on the CRA. So that's just one of the tools that we do use, and that can be up from receivables, again, equipment and real estate. Now, having a current appraisal is going to be very helpful here, but these lenders also understand that these CRA challenges are there, and they're happy to pay out the CRA with their proceeds. Next is a working capital loan. So these are typically shorter term injections of cash. We're talking 1 to 2 years, 3 to 24 months. These are going to be very, very quick turnaround times. It's good. There's the due diligence is very light. We're looking at just some financials. We're looking at how much cash flow they can support on a month-to-month basis. And then we're looking at turnaround times within about a week or so. So this is a good tool for us to use. They may have a little bit of a faster repayment time, but they are going to be essentially repayable, and we use them as a bridge in order for them to clear up some of their financial obligations, and then we can bring them again onto some kind of a banking product there. And then lastly is invoice factoring. I'm sure you're familiar with this. This is just using the invoices they have. Sometimes they've got some large orders from Costco or Walmart or, some of these blue chip type customers with 90-day payments, even up to 120 days. How often do they get paid on early? Very unlikely. So what we do is we leverage those receivables, get some cash in from them, and use that to pay off obligations. So that kind of, it just shifts the cash cycle a little bit, but at least that way it gets them some cash in, helps them grow their business, or at least take on some other projects while they still have this obligation of CRA. So that's why we always see these scenarios come in quite often, especially because of COVID and the pandemic. So knowing that a lot of these businesses are in that situation now, we found that we pieced it together through a few different avenues. It's not going to be a one-stop shop, or one solution is going to be the end all be all. We look at a few different avenues that we can try to get enough capital to be this array. At least gives you enough leverage to have that conversation with them to either work out a payment plan or see if they're willing to cut down some of the amounts that owed, right? A lot of times the CRA just needs you to come to the table with something, and this is a tool to help you do so. And yeah, so then, like I said, we would piece it together. So in something like this, we would look at their assets. We would look at, a 1 week kind of turnaround time on an asset-based loan, get them about 250K through, through their assets like equipment and real estate, because given it was a manufacturing company. And then the other part of it being a working capital loan is going to be a 2 year term. We get this turnaround within about 3 days or so. And that's another quick turnaround. Again, a little pricier, but it is going to help them facilitate growth later on in the future. So it's a small price to pay in the interim, but in the overall long term, there's going to be quite a bit of savings that they can get from their interest expenses, as well as their payments and penalties from the CRA. And like I said, we're really just trying to figure out a solution to help go back to the CRA, help them negotiate. A lot of times you're the ones who are going to be in those negotiations. So this just gives you some kind of ammunition to have that conversation.
Great, thanks, Byron. Awesome. So I guess for our next scenario is pretty timely. So you may have clients that are experiencing or experience seasonal swings. You could think of landscaping businesses, for example, or e-commerce businesses. So if your clients approach you for solutions on how to address this cash crunch, if there's significant cash outflows, working capital is just always there as a need. In fact, is a use case that we most commonly fund here. So working, to whether it's addressing CRA payments, like Byron mentioned, or inventory marketing. So in this scenario, you have a client that has come to you. They've identified that they need 350K to fund some inventory purchases ahead of Black Friday. So I'm going to turn it over to Byron again to take us through some options here.
Yeah, so in this case, again, this is a true growth scenario. Businesses looking to capitalize on Black Friday. They get some bulk discounts, they get some, discounts that they can order ahead of time. And also just making sure they can meet their lead time, right? A lot of these businesses may have, 2 to 3 month lead time and want to make sure we get ahead of it quickly so that they're able to access. Now, if you can go down the route of going to a bank and talking to TD or talking to RBC, you're talking to your senior lender and asking them for an increase in your line or asking for a bulge, and that could take, months, weeks to months on end. You may have, 2 months of a timeline, and then at the very end they decline you, and then now what, right? You lost 2 months, and you could have gotten you could have put some orders in already to receive that inventory. So you're in a bit of a pinch. The other scenario part of this is that, you'd be taking on some of these loans, you could take on a term loan, but you'd be carrying this debt for, 4 to 5 years, and you're carrying all this interest for something that's going to be turned over in about 6 months, right? That doesn't necessarily make sense for a lot of these businesses on a cash flow perspective. So what we would be looking at is how can we leverage the business's cash flow currently, knowing it's going to be a short-term need, to actually get them a quick injection and repay that off quickly. So yeah, you're paying a little bit higher rates, but you're not accruing as much interest in the long run. So back to our previous example, we'd be looking at things like a working capital loan, which is again quick injection of cash. We'd be looking at about 1 to 1.5 times their monthly revenue. If they've got a large seasonality, we can even budget that in there as well, and we'd be getting a very quick turnaround time. So this is going to be a quick lump sum cash, low due diligence requirements, not a whole lot of closing stipulations. Get the funds in their account for them to make that order when they need to. The next thing is on purchase orders. So, with Walmart or Costco or some of these larger ones, they may already have that kind of order in there. Knowing you're going to be releasing these finished goods, or you're going to be actually providing them um, these items, we can actually get funding against it. So it's called purchase order financing. So we get the purchase order, we get a lender to say, you know what, okay, we'll fund this, we'll fund, 85% of this, you cover the deposit, we'll do the rest. And then when you get paid by the end customer, that's how the loan gets settled. So it's another very strong solution. And this one really is only about 120 days, maybe 150 days, depending on how long the actual cash conversion cycle is and how long your order is. And that way, you're only paying a certain amount of percentage per month versus overall long period of time. And then lastly is getting set up on a business line of credit. So, banks, and they'll always take security. They're always going to take, receivables and take a first business GSA. That's very cumbersome. It does take a long process. And again, it requires annual reviews and fees and lawyer fees and whatnot. So a business line of credit through some of our alternative lenders is going to be, again, tied to more so your cash flow. It's going to be an allocated amount that's available for you, and you can basically draw on it as needed, pay it off as needed. Pretty straightforward. It's pretty strict, but you won't be able to get as much, and it's going to be a little bit higher rate. But again, it's kind of the cost of capital to get is the cost for capital at a very convenient, I guess, pace. You can get them a lot quicker versus having to go through an overall bank.
Thanks. So now in our last example, and this is something that you're probably seeing more of. We see a larger number of businesses up for sale, changing hands, including a growing appetite for accounting firms to acquire other accounting firms. So in this example, your client has come to you. They've got an existing dental practice and looking to acquire another practice for about $1 million. Looking to finance renovations, upgrades, get them on board with their systems and way of operating, as well as financing, marketing, and a working capital buffer. So I'll turn it over to Byron to introduce some options on how this established business can expand here.
Yeah, so in an established business, and I kind of want to talk more broadly versus just the one scenario that we're talking about. There are quite a few ways that an established or mature business can grow, right? A lot of it's going to be through inorganic growth, which is acquiring another business. You've been leasing your property and you want to go to a different space, and that can take on additional capacity. That's, a commercial real estate loan would fit in that place. Even just a term loan, right? You want to hire somebody, you want to do some product development, you want to invest in tech. especially with AI being such a strong or at the forefront of where everything's at right now, and putting some money in there, investing in how you can, automate some of your processes will ultimately help with your bottom line. But that does take that initial injection of cash to help you. Now, your business has been around for quite some time, stable, you understand your market, you have a product market fit, you've got good margins, you've got good cash flow, and you truly understand, who your customer is and what you're ultimately building there, right? So now knowing that, you want to take it to the next step. You've already gone through your initial growth phase, and now you want to take the next step. So these are just some options that are out there for you to kind of go through that process. So again, term loans are going to be an injection of cash used amortized over a few years, and it gives you some of that time to actually build up that ROI to on some of these processes or these investments that you're going to be making. Commercial real estate, you can look at 30-year terms. You're saving your rent, you're actually building some equity in the company, and you've also got an asset on your balance sheet. Now, when it comes to lending in the future, and when it comes to your asset valuation or your company valuation, this will exponentially increase that. Acquisition financing, like our old scenario, is going to be tied to the cash flow of the company you're acquiring. So the company you're acquiring, in theory, is going to provide some kind of a strategic boost or even just diversification. But there is some element as to why you're acquiring it. There are individuals also able to acquire businesses as well. And we'd be looking at the cash flow of the company you're acquiring. Can that company service a loan? And if it can't or maybe not, then we'd be looking at, can your company help support or supplement the cash flow there? So when we're looking at it from a debt service coverage, we'd be looking at it from twofold. And in these cases, we were able to get potentially up to 100% financing on an acquisition. And then lastly, it's a line of credit. So this is more so it gives you some operational flexibility for you to actually take on different projects, take on different investments, and be able to repay it at a speed that you'd like versus having to make monthly principal and interest payments. A few different tools that we'd be looking at from an expansion standpoint, and especially now with a lot of these businesses and a lot of these business owners, retiring, we've seen acquisitions really take off for a lot of industries such as roll-up ventures, healthcare, dental, HVACs. Like that's just one element. That's a lot of PE focus, but there's a lot of just other small businesses saying, I want to acquire another accounting firm. We can help with that. We've seen that plenty of times in the last 2 years, and rolling it's only going to build from there. And yeah, in this scenario, so with that, with the acquisition we're looking at, we'd be funding it, 80% of it be coming from an acquisition loan, knowing that the company would be able to support the payments without actually affecting your current company's cash flow. And then you'd be putting in 200K either from equity or from the cash from the company. That could also be supplemented through a vendor note, seller financing, an earnout. So there's a few different structures that we can work with, and I implore you guys to have those conversations. There's ways you can structure it. You are going to be the forefront of these conversations with your clients when they are looking for this. So knowing and arming yourselves with the different terminology and the different structures in which, these types of loans can be put together, these types of LOIs can be built, that'll help you quite a bit when it comes to building that rapport, building that trust, and then actually helping them secure funding overall.
Thanks, Byron. So yeah, I always learn a lot from Byron. So yeah, if you do have any funding scenarios coming up, happy to make an introduction there. Okay, so here's where we bring it all home. So I want to dive into some practical strategies for you to start to embed funding advisory in your day-to-day deliverables. Whether you're a practice leader that focuses on year-end compliance, maybe you're a bit more involved as a controller or fractional CFO, through to if you're really getting into the advisory seat in the business and looking at ways to strategically structure the business for long-term growth. So this is the other side of that key visual that I mentioned, that one pager. So I'll share this with you following our call. But really, where I think funding advisory fits in practically for firms, just I think boils down to just being curious and empathetic. The reality is that it's tough business running a business, and you probably well know that from running your own. Your clients will ultimately value your interest in the shifting currents in their day-to-day operations. So, for example, if you deliver a compilation, few questions that you could ask that could lead into some opportunities to capture either new service revenue or delighters to increase the long-term value of your client is quite simply how are you going to pay your HST? Or, I see this growing list of payables. How are you looking to address that? Uh, do you do you experience any seasonality in your business? And if so, how do you deal with that? I see you've got some debt on the books. What kind of rates do you see currently? And would you be interested in exploring an opportunity to refinance that to see if you can access better rates? And then just generally, are you looking at acquiring new assets, new equipment? What else is on your roadmap as far as key investments for this year? So, and actually another one, question I didn't have on here, but one that I learned from Byron, asking what their goal is from a business standpoint is their goal to minimize tax, or are they looking to present a profile of a business that is attractive to lenders or investors, meaning there is profit at the end of the year, so that when a lender looks at this, when an investor looks at this, that there's something to go on, something to fund against. So I think knowing that will help with long-term funding opportunities for your clients. And so some easy ways to layer in, that you have the capability to help them with funding is essentially including a line in your instruction letter for your clients paying their HST or their corporate tax obligations. Need help paying the CRA on time, ask us for help, and we can introduce Swoop to help ease the financial burden of having to finance that themselves or go into CRA debt. Uh, Adding a checklist item in your working papers uh, file for just doing an assessment for you know debt, debt refinance or grants or a grant review exercise. And then you can lean on your partnership with Swoop to provide a free insights report to identify opportunities that you can share with your client. So really just stepping into proactively looking for options before your client ends up getting into trouble or misses out on a growth opportunity. Similarly, if you're more involved in a role of, say, a fractional CFO or controller, um, the same questions as noted previously, particularly relevant, but just being intentional about knowing about their intentions to grow. So are you looking at hiring, making any significant investments? Are you looking at taking on any new projects? So you can offer them, a funding consultation or grant mapping exercise, and again, lean on Swoop to provide some support for these conversations. If you're looking for strategies to test advisory offerings in your firm, I know that that's quite trendy. I think compliance operate, keeps us busy enough sometimes, but we always have this aspirational uh, uh, interest in offering more advisory services. So an easy way to start is really to offer educational webinars like this one. And you can even look to partner with your vendors like Swoop, um, and talk about topics that are important to your clients. So for example, we've hosted a grants webinar and a funding products awareness webinar, and these are intended to be educational webinars. So what was great about that is that we see over 100 folks register their interest in that, which tells us that there's a strong demand and interest around funding generally, around grants generally. So being proactive in offering those types of educational webinars to your clients can be a great way to uh, you know, dip your toe into advisory. So we also have a library of resources that we share with our partners to bring this kind of content to their clients. So, a grants calendar, we've got loan guides, funding calculators, success stories that you can share that are kind of make the approaching funding options a little less intimidating for your clients. And then lastly, kind of as your client's business matures, they'll undoubtedly look to you for assistance with their major decisions from acquisitions, restructuring, launching in new markets. So again, it just boils down to, I think, asking questions about their long-term goals. Are you investing in R&D? Are you looking at launching in any new markets? All of which open up opportunities for, say, SR&ED or can export grants, as well as overall just being in the driver's seat as far as structuring them for long-term success. And again, you can lean on modern reporting tools as well as a funding insights report from Swoop as a way to steer these conversations. And just to summarize, we're really here to help. That's we're in business to do, and would love to really continue our conversation, explore what partnership looks like together. So, as I mentioned before, our model is based on success, and it's through working through partnering with your firm. We could really bring this marketplace of financial possibilities to your clients with a single application, which I think makes it a whole lot easier to approach. Now, to make it easy to get you started, we offer our partners a free portal to track and manage their client opportunities and a dedicated point of contact. But we also have, if you're looking to expand on your partnership with Swoop, we also have a branded customer white label portal, as well as a revenue share option as well. But in terms of where we're able to help, it doesn't stop there. We're here to provide education. So in fact, we have had success in hosting seminars like this with internal teams, just to make their client-facing advisors knowledgeable, at least at a surface level, on what funding opportunities exist and how to address those, through to marketing templates, our partner portal, as well as our funding insights report. So if you'd like to get set up as a partner, please feel free to reach out to me. I'll share my contact information in just a moment. And quite simply, it's easy to get set up. We have a partner portal where you can manage your team, set up a call with your funding manager, and then start working together on some opportunities. So that's about it from us. And now I think we're got about 10 minutes here for any questions that you may have. Oh, and one thing to mention, and I'll also follow up here in an email. We have a funding community that we're developing on LinkedIn. It's a small community of accountants that care about offering funding solutions, and it's a channel through which you can submit questions there. So I'll share that invite with you if you're interested in joining. Oh, okay, let's see. Let's open up the Q&A panel. No questions here. Actually, I have one. Byron, you kind of touched a little bit on SR&ED. And I think for a lot of folks on the call, certainly SR&ED is a pretty common thing that comes across their desk. Do you mind kind of sharing a little bit more about SR&ED Advance and kind of the challenge that helps to address?
Yeah, absolutely. So obviously, when with accountants, they're working on, filing SR&ED and looking for incentives that companies can access and utilize to get additional capital back, right? If you've spent this amount of dollars, you're entitled to receiving this amount of money back, and that could be a very good way for cash flow planning. Now, what we see is a lot of times, you file with the CRA, it takes about 90, maybe 120 days before for the actual approval and actually getting the funds back into your account. So that's poses a significant cash gap or cash flow challenge if you are expecting that. So what we see is we look at it as almost like an asset, right? It's essentially a receivable from the government. It's something that you were entitled to and you were eligible to, and now you're just kind of waiting on this capital. So what we look at in these cases is we'll look at getting it advanced against the shred. So that could be, 75, maybe even 85%, up to 90. Sorry, up to 90%. And essentially it'll be a funds coming into your account now. You can use that. Yes, there is an interest rate. There is an interest fee associated with it. It's pretty marginal given that it is pretty low risk in terms of receiving the capital back. But you can use those funds now for other shred eligible activities. Like for example, you want to hire a developer or you want to put some money into this product development. Like that's eligible money you have now that you could actually get the funds back in your shred claim the following year. So there's ways that we can kind of get a little creative with it, and having that cash in the business now, we can actually unlock further capital in the future. And there's other ways we can look at it, such as accrued shred. So, if you're in Q2 and you've already accrued 100,000 or $200,000 in shred, we can get an advance against that. And the idea is that you use these funds now. It's going to help grow your business. It's going to help you utilize the resources that are available, and ultimately you help you get additional shred claims or a larger amount in the future. So just one of those tools that we kind of explore and we present to businesses, especially when they're on the fence about it. Knowing there is an interest rate, there is going to be a benefit behind all of this, and it's just how do we accelerate capital into the business, knowing you are waiting up for some of these receivables.
Awesome. Thanks, Byron. All right. I'm just going to do a quick check to see if anything else trickled in. Um, but if not, I guess we'll wrap there. As a follow-up, I'll share our resource pack with everybody on the call, as well as the recording of today's session. And then, yeah, I would love to connect with you following this event to get your thoughts and feedback, and be excited to explore the conversation of partnership and seeing how we can make the world of financial possibilities easier for your clients moving forward. Thanks everybody for jumping on. Thanks,
Cool.
Byron. Have a good
Thanks,
one.
everyone. Take care.